Canada's top banking regulator will soon introduce guidelines for the mortgage industry. This is aimed at reducing the risks of the negative amortization mortgages. What does that mean? This is where home loans where the payment terms have ballooned by years because payments are no longer enough to pay down the loan on original terms. This month, the Office of the Superintendent of Financial Institutions is going to unveil new guidelines for banks and mortgage insurers. Among the expected, the aim is going to be to reduce the negative amortization mortgages. About 1 out of every 5 Canadian mortgage is now negatively amortizing, which happens when years get added on to the payment term of the original loan because the monthly payment isn't enough to cover anything but the interest. Let me explain with an example. Let's say you took out a $650,000 mortgage and the interest rate at the time when you took out the mortgage was 3.5%, and you had a 30-year amortization, and your payment was $2,700. Out of the $2,700, $945 went towards the principal, and the rest went towards the principal. Now that the mortgage has come up for renewal, and your interest from 3.5%, let's say, jumps to 6.5%, and your new payment is $3,800. Now, out of the $3,800, only $558 goes towards the principal, and the rest is going towards the interest. What that means is no longer it's going to take you 30 years to pay off your mortgage. It's going to be something closer to something like 37 years to pay off the mortgage. That is what it's meant by negative amortizing mortgages. And this has all happened because of the interest rates rising over the past year and a half. Exact numbers are hard to come by, but regulatory filings by some of the biggest banks show that the negative amortized loans make up a large and a growing pile of debt. Roughly 1/5 of mortgages on the books of TD, Bank of Montreal, CIBC were in negative amortization territory in the last quarter. That's almost $130 billion in housing debt, where instead of standard 25 years of amortization, it's now going to be 35 or 40 years to pay off the debt. And with roughly 100,000 mortgages coming up for renewal in Canada, the pile is going to keep growing and get bigger and bigger. Some lenders will limit the possibility of these negative amortization mortgages by asking borrowers to come up with a lump sum payment or putting them on fixed interest rates. So these are tough times, and that's why you need to work with professionals at Seacliff CPE to look at all the options and make the right decision for yourself and your family.